This is what intraday trading looks like for the majority of market participants, a constant, chaotic collision of unstructured data. Retail traders spend thousands of hours isolating patterns in this noise, reacting to every standard intraday order block forming on a 5-minute chart. The problem is that these standard order blocks almost always fail. They are isolated fragments of data, lacking the critical context of macro-spatial boundaries, which means traders are buying and selling in the middle of empty space. True intraday price action is not random. It is strictly dictated by institutional volume nodes that are established at precise, recurring times during the session open. To stop reacting to the noise, we have to look past the surface-level price movement. Today, we are going to construct a complete institutional order flow pipeline from the ground up. By the end of this breakdown, you will see exactly why long-term survival in quantitative trading requires abandoning discretionary pattern recognition entirely, and instead mapping the exact limit order grids used by institutional algorithms. To build this pipeline, we rely on two distinct mathematical components working in tandem: the Genesis anchors, which provide our macro map, and the True C Matrix, which acts as our micro execution engine. We start with the map. A Genesis block is a rigid spatial bounding box. It isolates the very first high-volume displacement candle of a specific trading session. Once that macro boundary is drawn, the True C Matrix takes over. This is the temporal execution engine that tracks the internal wave logic of the order flow strictly within those physical limits. Attempting to apply the matrix logic without first anchoring it to a Genesis block is a mathematical dead end. You will end up executing on false, low-probability signals because you lack the correct spatial parameters. Mastering institutional order flow requires executing both steps in order. First, define the physical limits of the playing field. Second, track the wave logic of the capital moving inside it. Let's lay out the exact physical limits across a 24-hour cycle. There are 3 critical windows where institutional players inject massive volume. The cycle begins with the overnight Globex anchor, initiating at 1800 Eastern. Calibrated for index futures like NQ and ES, global banks quietly build positions through the Asian and London sessions. We isolate the first major displacement candle here. Its exact 50% midline, consequent encroachment, becomes our macro fair value anchor heading into the morning bell. The second window is the pre-market anchor, initializing at 0400 Eastern. Designed exclusively for single-stock equities and ETFs, it captures early institutional positioning and earnings gap rebalances hours before retail traders open their brokerage apps. Finally, we reach regular trading hours, the opening drive anchor at 9:30 Eastern. Ignoring overnight positioning completely, it isolates the pure, raw momentum generated by the massive influx of volume exactly at the opening bell. This creates the immediate opening range equilibrium. If the current price holds above this specific 50% midline, buyers control the session. If it breaks below, sellers have command. These 3 anchors give us our map. By locking them in, we mathematically define the precise locations, the where, of institutional intent, long before the retail public reacts to the price action. With our spatial boundaries drawn, we can move inside the blocks to track the micro-timing of the capital using the ABC wave cycle. Step 1 is the A wave. This is the initial macro impulse exploding out of the session open, creating our fresh Genesis block. This rapid upward expansion moves so fast that it leaves passive institutional limit orders completely unfilled. That creates the requirement for step 2, the B wave. Price begins to trace a structural pullback. Retail traders often interpret this sharp drop as a trend reversal. In reality, price is executing a mechanical return to fair value to collect the liquidity left behind. We know exactly where this pullback will end. The B wave terminates precisely at the structural confluence of the Genesis 50. Instead, you see a highly predictable mechanical sequence of limit order absorption. We can now translate these wave mechanics directly into algorithmic trade parameters. This gives us our first strict mathematical setup, the midline retest execution. Your exact point of entry is placed perfectly on the Genesis 50% midline, waiting for the B wave to return to fair value. Your stop loss is anchored safely past the opposite boundary of the Genesis block, shielding your risk. Target 1 is set at the opposing range edge, where you systematically de-risk 50% of your position. Target 2 executes your full expansion scale-out at the mathematical positive 1.0x Genesis expansion line. The second execution model occurs when price bypasses the midline entirely, the breakout execution. The strict trigger requirement here is a closed interval. A 5-minute candle body must close completely outside the established Genesis high or low. Once verified, the risk parameters immediately shift. Your stop loss moves up to the 50% midline, and your profit targets dynamically project outward to the positive 1.0x and 2.0x multipliers. This framework replaces discretionary guesswork with dynamic mathematical constants. You don't have to feel out the market. The parameters dictate every phase of the trade. All of this logic is bound by the system's golden rule. You must never, under any circumstances, trade an intraday order block in isolation. The target path of any micro-execution you take must logically align with the next major Genesis milestone, whether that's the midline, the range boundary, or the specific expansion vector. When you align the micro-timing of the matrix to the macro milestones of the anchor, you step out of the reactionary panic that defines the retail public. Traders who ignore this alignment end up executing directly into structural resistance, predictably tracking themselves in standard B-wave liquidity grabs. Context is absolute. Without macro-spatial permission from the Genesis block, your micro-trade setup is mathematically invalid. We can now view the entire pipeline fully assembled across a multi-day chart, tracking the market with absolute structural clarity. The Genesis block explicitly dictates the where, providing the necessary macro bias and the structural profit targets. The True C Matrix explicitly dictates the when, giving you the micro timing required to safely trade the limit absorption. Before executing your next trade, toggle your preferred session anchor so it matches your specific asset class. Establish the parameters, map the grid, and let the mathematical constants define your risk. True quantitative edge is not found in predicting random price fluctuations. It is found in stopping your reactions to the noise and executing mechanically alongside the institutional limit grid.